Hello, Dr. Nida. Oh, you unmute as well. A second. Yeah, Dr. Nida, you should be able to speak up now.
Yes, thank you so much. Assalamu alaikum.
I can say I'm welcome on board. Okay.
So it works well. I can go off now.
Yes, you can. Sure. Thank you. Hello, Dr. Ziad. You should be able to speak up now.
اوكي السلام عليكم ورحمة
وعليكم
الله.
السلام. مرحبا بكم.
الله يبارك.
If you want to go off camera for a moment, you're free to. So when it is time, you can just start.
اوكي خير ان شاء الله.
But we'd like to see your face, of course.
بارك الله فيك.
Come on. And we welcome everyone on board. Let's just wait a couple of minutes to see more participants to join before we kickstart. Thank you. Hello, Assalamu alaikum 𝗓𝗏𝗧𝗏 everyone. Welcome to Islamic Finance Connect. I'm 𝗓𝗏𝗧𝗏𝗺𝗵. We'll be moderating today's call. We really appreciate everyone who came to time, and we shall start the program now. The topic of discourse today, like we all know, is as it has been displayed on the screen. CBDC, so to say, which is central bank digital currency. It is a hot topic in the world of finance and technology currently, and there are a lot of factors that people are looking into, and this is actually a very big topic. When we talk about the adoption and implementation of CBDC, many countries around the world are exploring the possibility of issuing their own CBDC. Many countries in every global space, you talk Africa, you talk Asia, you talk everywhere, people want to actually look into CBDC. And how is this going to have impact and the challenges that we're going to face globally, such as technological infrastructure, legal framework, and interoperability around the world? So it's a very huge one. Another factor that is very important for people to think about here is the monetary policy and financial stability across the globe. And here we'll also be looking into the interest rates that could be into these, the money supply, everywhere, the way business moves around the globe. I'm talking about e-money, CBDC here. And like we all know, interest is actually a very big topic in the Islamic finance space. So this actually has a lot of ramification that we need to look into, and many other factors as well to consider. Privacy and surveillance concerns, we have cross-border payments and remittance, we have digital identity and authentication, especially in this global world of cybercrime and fraud and a lot of things, international monetary system and geopolitics. So there is a lot to think about in the world of CBDC. And this is why Islamic Finance Connect has a very key pioneer of Islamic finance globally has looked into this topic as it is rising, and we bring forth to you some professional too, in fact, that they're academician, they also work in the industry, and they know fully well what is actually happening around the world. And they are the ones we've brought forth to you today to help discuss this topic of CBDC. And this is a webinar organized by Islamic Finance Connect, like we all know. We brought forth Professor Ziad, and we have Dr. 𝗓𝗏𝗯 as well. Dr. 𝗓𝗏𝗯 is someone I've known for a very long time. So also Dr. Ziad. And before we kickstart today's topic, we enjoy everyone to, if you have any question, anything to post in the chat, it is open. We catch up on them after the talk. But before we start at all, I would like to start the topic and start discussion, which is going to start from Dr. Ziad. And the topic Dr. Ziad is going to be taking today is around CBDC and data privacy and Islamic perspective of things. We know as Muslims, there is nothing that Islam has not actually given one contribution or the other two. But before I call on Dr. Ziad, I would like to give us a little profile of Dr. Ziad. Dr. Ziad is Associate Professor, Lead Researcher, Sharia for Center of Excellence in Social Finance, and Head of Online Programs at INCEIF University. He is the former Associate Dean and Director of Executive Education and E-Learning at the same university, INCEIF. Dr. Ziad has advised financial institutions and regulators in Islamic finance, regulations and social finance, fintech and sustainability for almost 25 years. His work spans over 20 countries with more than 12,000 participants attending his training program on various aspects of Islamic finance. Dr. Ziad has led numerous consulting projects on policy and strategy for large financial institutions and governmental organizations in the UK, Malaysia, Kazakhstan, and Pakistan in Islamic banking and takaful, sustainability, sukuk, fintech, and social finance advancement. He's also served as a consultant to the World Bank for Sustainable Development of Islamic Finance in South Africa and Southeast Asia. Dr. Ziad is also adjunct associate professor at the Asia School of Business in collaboration with MIT in the US. He served as lead consultant on several sustainability projects for financial institutions in Malaysia, providing social impact and ESG assessments and strategies of value-based intermediation. He served as Sharia lead in the development and sustainability framework for Islamic banking in Malaysia, VBI, and project lead for the initial drafting of the sustainability framework for the takaful industry in Malaysia, VBIT. Dr. Ziad is chairman and member of several Sharia boards internationally, including EduPro in the UK, HSBC Amana and Munich in Malaysia, Taj Bank in Nigeria, FBN Quest and 117 Capital in Nigeria, Ayadi, Takaful and 𝗵𝗵𝗄𝗵 Islamic in the Midwest, and iConsult Africa in South Africa, among several others. He holds masters and PhD in Islamic finance from INCEIF in Malaysia, an MBA from South Africa, a BA Honours in Business Finance from the UK, and certification in Islamic Science in South Africa and Jordan. He lectures in Islamic jurisprudence, laws of contract, sustainability, and social finance, with over 100 publications in academic and professional output. His research area are in social finance, fintech, sustainability, Islamic jurisprudence, and development policy. This is just a brief of Dr. Ziad. It's more than what I've just quoted. I would like to leave the floor for Dr. Ziad to give his presentation. He shall be discussing with us CBDC and data privacy and Islamic perspective. Professor Ziad, Assalamu alaikum.
Alaikum salam wa rahmatullahi wa barakatuh. Jazakumullah khair. Thank you very much for the opportunity and also to share the platform with the respected and honorable Dr. Nida Khan, and of course, my dear brother, Brother Ibrahim Ahmed. To all the participants and for the session today, we're going to be covering CBDC, inshallah. Let me begin with the sunnah of beginning. Bismillahir Rahmanir Rahim. Alhamdulillah, alhamdulillahi Rabbil Alameen, wassalatu wassalamu ala Sayyidil Mursaleen, Sayyidina Muhammad, wa ala alihi wa ashabihi ajma'in, ma ba'd. اللهم افتح علينا بحكمتك وانشر علينا برحمتك يا ذا الجلال والإكرام. رب اشرح لي صدري ويسر لي أمري واحلل عقدة من لساني يفقهوا قولي. The discussion, yes, on CBDC. However, I will cover the basics of CBDC to begin that discussion, and perhaps the progress that the international market has been making with the application of CBDCs. And then I'm going to touch on where Islamic issues arise in CBDCs. Now, we have to bear in mind as we begin the discussion that from the Islamic perspective, there has been limited opinion on the issue of CBDCs simply because there has been limited implementation. So a lot of what I will mention a bit later on the Islamic issues will be things that we need to consider, because existing opinion is that CBDCs really are just a digital form of the existing fiat, and therefore there should be no Sharia issues. I beg to differ, and we posit some issues that will or may arise with CBDCs as well. So very briefly, I'm going to cover what CBDCs are, which countries have applied them so far, what are some of the advantages, are there any risks in CBDC implementation, and throughout the process, we will try to highlight some of the issues from the Islamic perspective. So what are CBDCs? Central bank digital currency or government-issued currency in digital form. Now, this is slightly different to what we understand as e-money. From an e-money perspective, that e-money is held in a digital wallet or in a wallet of a bank, an e-wallet of a bank, And therefore, the relationship with that money is with an intermediary, with a bank. When it comes to CBDCs, there is what we refer to as the potential for disintermediation. Why? Because the CBDC is directly linked to the central bank. So it's as if you have an account with the central bank. And any trades or transactions in a direct CBDC, and you will see there are two different forms, or three different forms at least, of the CBDCs, then that now moves your account away from a bank into the central bank, and we would need to think about the Sharia issues that arise there. It's not pegged to physical commodities like stable coins are. It's similar to stable coins, but the differences would be that this legal tender or liability would be directly with the central bank. It's not necessarily on a blockchain. Recent studies with MIT and the Federal Reserve, as well as other central banks, has found that the use of blockchain may only provide a scalability of CBDC at about 10% as compared to non-DLT versions, or the distributed ledger technology, which runs the basis of the blockchain concept. So again, there is this misunderstanding that, well, a CBDC is really trying to solve the cryptocurrency version, and it's not really a misunderstanding. I mean, there is an argument that's a positive in there, but crypto is really very much based on blockchain, whereas CBDCs may not necessarily be based on blockchain. The other thing is it's centralized. Crypto is generally decentralized, so there is another distinction. Now, it's a fact that 80% of central banks have already been considering or have implemented CBDCs at some level. Now, the majority of CBDCs applied today are really at the wholesale level. Now, we need to understand why wholesale. Well, you have two different versions of the application of CBDCs. If you're looking at the right side, and that's the retail and the wholesale versions. The retail CBDC is very much like the e-Naira that you have in Nigeria. And that e-Naira sits in its e-wallet, and it allows for everyone, households, companies, institutions, to utilize the CBDC. However, wholesale CBDCs, as what is practiced here in Malaysia, is really to facilitate central bank to central bank, or central bank to financial institutions outside. And it's really ideally used for cross-border transactions. It's similar to reserves that a bank would have, and then the central bank then uses these reserves or conducts settlement balances through the process. Now, the advantage of wholesale CBDCs is that it allows for tokenization, it's programmable, it has a host of new functionalities that one can add on through the process, and this can be enhanced over time. There are substantial advantages, and we only have 20 minutes or so, so I'm not going to list all of those. The hybrid CBDC, well, yeah, it just combines retail version, meaning it's practical from the household and firm perspective, as well as cross-border payments. Now, on the other side, the left-hand side, more around the legal jurisdiction, we have the indirect versus direct. So the direct one is what we've just been talking about. The majority of the work taking place here in Southeast Asia, in South Africa as well, in Nigeria, that is all around direct CBDCs. And you'll find that that does not necessarily have an intermediary. Indirect CBDC, there's a commercial bank involved in the center, and your wallet or your e-wallet is being held at the commercial bank, and then, of course, at the central bank. So that's the intermediation or intermediary process. Hybrid would be a combination of the two. So which countries have applied CBDC so far? Very quickly, and I'll just summarize this slide. The top 10 retail CBDC projects, Nigeria, is the latest entrant in terms of actual application. That means it has a successful pilot. It has implemented the e-Naira. The Bahamas, of course, they came in much earlier. Jamaica came in earlier with the sand dollar. So you have these early versions. And when I say early versions, we're talking about the last 3 years. So these are the top 10 retail CBDCs. But there have been several countries that have exited. That means they've decided that perhaps this CBDC approach for now is not for them. That's Cambodia. They've chosen a different approach to CBDCs, although they will still be working with electronic money. Ecuador has come out of it completely. Turkey as well has not really advanced any further with its original design of the CBDC. In fact, the advantage now is that we have data. We have data available on e-Naira, on the e-CNY or the digital yuan. So there's a little bit more of understanding of, at least from the Shariah perspective, whether there is a holding of the CBDCs at the central bank. Is there interest attached? Are these CBDCs being used for derivative trades and forward trades? So a lot of this discussion is evolving as we speak. And in fact, I have one master's student at the moment who is currently analyzing the e-Naira and its implications on policy, on fiscal and monetary policy. So this will be quite an interesting exercise to see what the outcomes are. On the wholesale side, again, you've got a lot of progress, but the UK has exited from offering wholesale CBDCs simply because they already have a system. They have an RTGS approach, real-time gross settlement approach, and other countries have similar approaches, Germany as well, considering kind of a trigger solution as an alternative to this wholesale settlement that's currently in practice or considered through CBDCs. And other countries and jurisdictions are considering even alternatives to DLT. So you've got Thailand and Hong Kong right at the top, and we'll talk about that briefly as two quick cases just to understand where they're at. First, Nigeria. In terms of its application, as I said, there's some data available already. The number of e-Naira speed wallets that were created, around 666,000 by the end of December 21. We're waiting for some more data to be verified, but that has increased substantially because there was a period in Nigeria where hard cash was not being printed and one had to resort to e-Naira. That caused a little bit of chaos in the market as well. So there are some disadvantages in implementing it without a very careful consideration of the implications. So right now, it's the first in Africa. It's doing quite well in terms of innovation. But in terms of actual assessment of its impact on the financial system, on the banking system, I'd say that that is still rather unclear. And simply because this has been a top-down approach. In my understanding, it's very much from the central bank trying to implement a more efficient way of transactions, also to reduce the potential for crime, financial crime, etc. So it's a lot of positive, perception or intention. However, when it comes from a top-down approach, that means that banks are expected to follow suit, and banks may not be necessarily equipped or even understand the implications on their own deposits as well. So it has been a phased approach, and as we say, there's still a lot of learning that's going to be taking place. On the wholesale side, you've got Thailand and Hong Kong. And here from 2019, they've already implemented this through a joint project, and the facilitation was primarily for cross-border payments. The advantage of this was that they could see whether this could work as a replacement to their existing systems. And because they did not have detailed or effective systems like the UK, the application of such CBDCs would really now facilitate more efficient trade. So what motivates CBDC issuance? And from the Islamic perspective, we now look at the maqasid. And the maqasid, or the objectives of Islamic law, would be to ensure that there is a preservation of wealth. And that preservation of wealth is also to ensure that those that are unbanked generally have access to the financial market and the economy. Now, it's not financial inclusion from the Islamic perspective naturally does not mean that you must have a bank account, although this is the general understanding from the IMF and World Bank. From the Islamic perspective, we want to ensure that everyone has an opportunity, an equal opportunity, to be able to interact with the market. And in order to do so, they need to have some tools. And those tools include tools of literacy and awareness. And the big challenge here in the motivations that you see around financial inclusion from the global sense is that they are not necessarily tying that up with awareness. And, ilm is a fundamental principle, a foundation in the Sharia. These are the very first verses that were revealed. And this concept of ilm means that we need to understand how we're earning our wealth and whether we're earning it in a halal way, and then how we're utilizing it. And that's, of course, our transactions and the forms and instruments we're using for those transactions. So that awareness and literacy levels are certainly not there. Overall, from the retail perspective, you see that domestic markets, domestic payments, efficiency, payment safety, these are priorities that both the advanced economies and the emerging economies are now converging towards. So they're working towards the same goals. But when it comes to financial inclusion, naturally, advanced economies already have achieved that. So that's not a focus for them. Whereas for emerging markets, they would still focus on financial inclusion. And a lot of the emerging markets, particularly in the OIC region, are Muslim majority. And you find that there is a disproportionate allocation of financially excluded, or disproportion to the amount of people that don't have bank accounts in the Muslim majority countries. And the idea of the CBDC is really to facilitate that. So there is an advantage from the maqasidi perspective for financial inclusion, so that you reach those that don't have access to banks, don't have access to bank accounts. They now can have an access through a mobile phone via an e-wallet and have the ability to utilize, just electronic money that's secure and safe. From the wholesale perspective, of course, financial inclusion is not the debate or the discussion in wholesale. It's really about facilitating cross-border payments. And that is priority, whether it is advanced economies or emerging economies. One good pilot study is the one done here in Malaysia, Australia, South Africa, and Singapore. It's a joint project done by, and that uses multiple CBDCs for a cheaper, faster, safer approach to cross-border transactions. So some of the lessons learned briefly. These are, the examples in the different countries. But when the APIs are designed well, then they facilitate more effective retail payments. So this means that when you have a solid approach from the e-wallet side that manages the CBDCs, then it's more adaptable. That means it can simply connect and integrate with central bank applications and even third-party apps. So that's an important element. And then here, privacy, which is a huge issue, everyone's concerned. Well, because now CBDC, it means that my name and is already registered, and any transaction that I make is going to be very clear to the central bank. And that that exposure of the data is a huge issue of protest. So one of the lessons learned is that privacy can be balanced with facility. That means you can provide effective facility for the trading and for the usage of CBDCs. And on the other hand, you can protect, the users. And this means that an example of it is one project, utilizing blind signatures, meaning that the user is actually unknown. So this protects the data privacy of the users. Now, there's pros and cons to that, but overall, I think it's a very important element on the data privacy side. The other lesson learned is offline CBDC payments are complex but possible. It means that if you're not connected to the internet, what happens then? Because if you are in a rural area in a lot of parts of Africa, you don't have a connection. And if you don't have a connection, what does that mean? You can't buy a meal, you can't buy food, you can't go on transport. So that becomes quite a challenge. It's possible. You can actually utilize offline CBDC payments, but it's complex and still, under a lot more development. Of course, it's already been tested. Now, from the Shariah perspective, from the Islamic perspective, we really need to take the risks very carefully. Because ultimately, the maqasid look at the preservation of wealth and life. And here, instead of going and listing all of the pros and cons, I'm going to give you perceptions and opinions of quite respected academics, Prof. Tony Yates. He's a retired professor, senior advisor to the Bank of England. So his views are that central bank reserves through CBDCs will now be more widely available. Initially, they were used for settlements to counterparties that were cross-border. Now those, or even locally, but those counterparties now expand to even households and firms and institutions. And the issue is whether this level of dilution and usage of central bank reserves is going to be safe for the financial stability of the country in the long run. The other argument is that if a country does not enter into CBDCs, then it's not future-proofing itself to global currency usage. His argument is that, well, the dollar has already secured itself. So global currency is still the dollar, and therefore that boat has, or that ship has sailed. But in order to remain relevant, it will still be about the financial health of institutions. It will still be about the ability of people to repay their financing. So it doesn't matter whether you use CBDCs or other forms of money, the affordability criteria and the credit risk still apply. The crypto threat was another issue, saying that, well, cryptocurrency is coming in and we need to counter that. Well, cryptocurrency has really not made the grade when it comes to use cases, especially on the broader side of being, substituted for fiat currency. It has limited usage at this stage. It's being used in particular environments. For example, your metaverse or your 3D internet environments, your Web 3.0, it's being used successfully there. It's being used to buy more crypto and trade in crypto. But is it used in standard trade? Then there's limited usage for crypto right now. So, is it really resolving a big threat? He argues it's not even a big threat at this stage. Financial inclusion, he argues that, well, the more effective way to achieve financial inclusion is to have a linkage with a bank. It doesn't mean you need to have a CBDC. You just need to have a linkage with a bank. And you need to expand on your literacy levels. From the Shari'i side, we argue the same. We say that it's really about understanding what you're getting into and having access and opportunity to get into it. On the payment efficiency side, he argues it's too costly, but that, I'd say, has been debunked in practice. And really, it's been shown to be quite cost efficient with systems in place. There are other views, and I'm just going to highlight one or two of them from Prof. 𝗵𝗵𝗆. He's a prof at Cornell. The last 3 points that he mentions are quite important in terms of financial stability and perception. Helicopter drops, that take place in crypto, they can take place in CBDCs, where central banks drop money into wallets. But now that money is not dropped through central or at the opinion of central banks. It's dropped at the opinion of governments in the perception of the people. So this can be used to manipulate voters and for some political advantage. Here, the second last opinion is that dictatorships and really benevolent governments may both abuse them. So dictatorships may, control the CBDCs and decide who gets what, whereas benevolent governments might excessively try to apply social activities and use this by their own criteria of ethics. And that becomes a challenge. From the Islamic side, one can see this as an advantage because it will promote good, wholesome activity, but then providing such power with governments may, lead the governments or the CBDCs to abuse. The integrity of the central banks may be in question because, as you know, they sit independent of government, and that is the protection of the stability of the economy. The fiscal policy versus the monetary policy. Fiscal coming from government, monetary coming from central banks. that line becomes blurred now with the implementation of CBDCs. Purely on the Sharia side, secondary market, that's where we have a huge issue, because when it comes to secondary markets, Prof. Prasad is arguing that CBDCs can now be used to trade money. And trading money at a discount naturally gives you a very clear Sharia implication. Because as we know, money cannot be traded at a premium or a discount. That will be riba. So that is a huge issue as well. There is a threat to banks, because banks are disintermediated. They removed from the line. The wallet that you have has money directly with the central bank, which means that money could fly. There could be flight of money from a bank deposit into an e-wallet that has CBDCs. So the bank doesn't have deposits. If the bank doesn't have deposits, it can't provide financing. And therefore, that can create significant amount of instability. So finally, central banks have not really made the decision to issue as yet, except for a few that have piloted it. There are several advantages and disadvantages. It should not be understood as a digital version of cash alone. And from the Islamic perspective, the Sharia rulings on CBDCs are not clear yet. A lot of the discussion I've had with Sharia scholars at the moment is that they see CBDCs as a digital version of fiat. But in effect, it is not. Why? Because fiat currency is held differently. It is utilized differently. The technology of fiat is slightly different to CBDCs. And the algorithm that can continuously improve the functionality of a central bank digital currency does not lie with fiat currency. So really, the potential is to the imagination of people. And that means that every time there's a new use case, you would have to assess it and screen it from the Sharia perspective. Right now, what I've identified from the Sharia perspective is that, number one, the issue of riba is not clear on the CBDCs, because the money being held directly between you and the central bank may give rise to riba, which you have no choice on because it's a regulatory imposition. Remember that a large amount of countries have Islamic banks operating in conventional regulatory systems. And that means that your relationship with the Islamic bank is ensuring Sharia compliance. When it goes to the central bank can't cater for all of the different requirements yet. And only dual banking systems like Bahrain and Malaysia and soon to be Pakistan are actually functioning in this manner. So what about the rest? Therefore, there would be a riba potentially on the money that you save in your e-wallet with the central bank. And that naturally gives rise to a Sharia non-compliance by default. That's number one. Number two, the liquidity issue. Liquidity being held can then be traded in the money market for riba purposes, for the purpose of earning interest. Again, you may be facilitating liquidity transactions that give rise to riba, even though you may not be directly involved in it. Number three, the issues around derivatives. So a central bank now utilizes these funds for a discounted trade. If they move into a secondary market, they may move into future trading or forward currency exchanges, and all of those based on riba transactions will now be an implication on the community or society that's utilizing these CBDCs. So that's the third issue. The fourth issue is around financial inclusion and whether it really truly achieves financial inclusion, because financial inclusion is achieved through literacy and access. If those that are elderly, living in rural communities are not literate on how to use smartphones, and yes, you will see that a large portion of Africa and even Southeast Asia, in terms of those sectors that are financially excluded, they may not use the smartphones at all. They use older phones, they have access, but there is limited usage. So how quickly would they be able to adapt? And therefore, what you see potentially going forward will be hybrid approaches, parallel approaches, CBDCs together with the standard fiat, until there is this transition, phased transition into more CBDCs. So I hope that that summarizes the issues around CBDCs and Sharia. We've covered a little bit of privacy issues. We've covered the approaches of CBDC, and it's still evolving and developing over time. We've seen countries come in and out of the use of CBDCs. Sharia scholars really need to dissect the approaches of CBDCs to understand the Sharia implications, but I'd say that it is work in progress. If scholars are still unclear about cryptocurrency, although there are many fatwa available, I'd say that CBDCs are really a green sector when it comes to Sharia at this stage. Jazakumullah khair. Thank you very much for your attention. You may ask questions. I can't guarantee that I know the answers, but you can pose the questions nonetheless. Thank you very much again for the opportunity. Jazakumullah khair.
Thank you, Professor Jazakumullah khairan, for the beautiful and wonderful presentation. And that's a lot's been said already around CBDC. And like we initially itemized, that the concept of CBDC, the interest rate, and the way Sharia lens is going to view this is a very deep one. And we can see Prof has just given us just tip of an iceberg. Is a very deep and ongoing discussion. And it was striking when Prof started by saying he begs to differ on this. Really, there's a lot of scholars there and a lot of discussion actually ongoing. And we really hope that many enthusiasts of Islamic finance are looking into this, as well as it affects our lives, financial inclusion, and many more. Looking at every part of the world, the last 2 points where you were summarizing around the way the technology understanding and the inclusion in several parts of the world is another thing to really consider. And it was interesting while we were talking about the direct, the wholesale, retail. These actually affect individual lives and businesses. Where is the central bank sitting in between this? Is it real e-wallet? Is it, are we talking Google Pay, Apple Pay, or any other thing entirely? This is a very interesting one. Thank you again, Professor, for the deep insight to this. Jazakumullah khairan. I would have loved to start throwing question and answer. I know people are already sending questions, but permit me, Prof, to quickly go to Dr. Nida. Then we can actually go through the question and answer session together. Before I call on Dr. Nida, I would like to give us again a biography of Dr. Nida. Dr. Nida is the CEO of Nash FintechX, a Luxembourgish startup providing software solution focused on sustainability and climate action. Her company has developed a pioneering carbon credit trading market, 𝗕𝗵𝗆𝗁𝗆𝑥, using fractionalized NFTs to help corporates provide transparency, validation, and accurate accounting of their climate efforts. She has also launched a calculator that can be used to calculate the carbon footprint and offers solutions to offset the footprint through verified green projects. She received the second prize for SDG Global Talent Award this year in the category of climate action in an event held in Norway, backed by the World Economic Forum for her software 𝗕𝗵𝗆𝗁𝗆𝗆𝗁. She has also been chosen as Global Innovator by Expo Live Innovation Program in Dubai for her solution 𝗕𝗵𝗆𝗁𝗆𝗆𝗁. Her company is ranked among the top 100 ESG companies in the world. Her software solution are Sharia compliant and can help corporates in realizing their climate goals. She holds a doctorate in computer science, where her industrial research on blockchain-based financial application was accorded the Luxembourg National Research Fund grants for innovative industrial projects. She has received VC training by 𝗵𝗵𝗆𝗵𝗆𝗆, where she emerged as one of the winners of the training program. She has worked on projects in social finance and decentralized finance, including tokenization. She's a pioneer in giving the economic impact of blockchain-based micropayment, developing a novel consensus mechanism for scalable blockchains, proposing a mathematical framework for blockchain governance, and ensuring GDPR compliance, privacy, preservation in blockchains. Her past achievements include developing 2 pioneering iOS and Android apps, where The latter had 10K plus installs. Her work appears in diverse publications, and she speaks regularly on emerging technologies. Before I go to Dr. Nida, just to introduce the topic Dr. Nida will be taking for us. So Dr. Nida, the floor is yours. You shall be discussing with us CBDC and FinTech, their roles and financial inclusion. Dr. Nida Khan.
Thank you so much, Brother Ibrahim. Assalamu alaikum, everybody. It's an honor to be here, and it's a pleasure to be talking to all of you right now. I'll just share my screen. Let me know if it is not visible. So, okay. And as I move on to the next slide, just let me know whether you see the progression or the screen is frozen for you. As mentioned by Brother Ibrahim, I'll be talking about CBDCs and majorly focusing on financial inclusion. We move on to the next slide, Brother Ibrahim, right? You see the second slide. Okay, thank you. So I'll just talk what exactly is a digital currency. It's any currency that exists in an electronic form. And basically, our fiat currencies can also have a digital representation, and you can trade them using electronic media like computers and smartphones. Now, central bank digital currencies, before we delve into understanding, Dr. Ziad has already shed light on it, and I'd just like to enhance upon it a little. So I'd like you to focus briefly on how central banks work as of now in countries.
In earlier times, many commercial banks issued their own banknotes. Since about 100 years, the issuance of banknotes has been the monopoly of privileged banks, which are called national banks or central banks for this reason. In the Eurozone, the national banks of the Eurozone countries form the Euro system and have a common central bank called the European Central Bank. Central banks print banknotes, put them into circulation, and also have the right to withdraw the banknotes and destroy them. Central banks also supply giro money. Commercial banks must maintain a certain minimum deposit with the central bank of the countries in which they operate. Commercial banks also have the opportunity to borrow money from the central bank. In exceptional situations, central banks buy government bonds and help countries finance their sovereign debt less expensively. In many countries, central banks are also involved in the supervision of commercial banks. Now, how does the monetary policy of a central bank work in detail? The central bank steers monetary policy through interest rates on deposits and loans, and on the other hand, through the minimum deposit required of commercial banks. The interest rate charged by the central bank is the main instrument. It's the so-called key lending rate. It is adjusted in regular intervals, taking the economic situation of the country into account. When a central bank wants to bring more money into circulation, it lends money to commercial banks at especially low interest rates. This makes it possible for these commercial banks to make the money available at less expensive terms to their customers. Whenever the money supply threatens to grow more rapidly than the real economy, the central bank also has the possibility to raise the key lending rate and the minimum deposit requirement for banks. This, in turn, reduces money supply.
So if you look at the screen, you see that this is the current architecture that is followed. You have the central bank, and then you have the commercial banks in between, and then you have the customers at the other end. And this is how majorly the economies are functioning. And this is done to bring about stability in the economy. And this is something that when we talk about CBDCs also, which will be very, very important as you see in the next slides. So what exactly is a CBDC? It is an electronic representation or a digital token of a country's official currency. They are majorly of two kinds, as Dr. Ziad already mentioned. So we can have retail CBDCs, we can have wholesale CBDCs. In retail CBDCs, what happens is that you are directly interacting, the central bank is directly interacting with the public. And what happens in wholesale CBDCs is that, you have the financial institutions in between, probably, which take the liability of the CBDC that has been issued. Now, there are different kinds of design mechanisms that are possible when you talk about CBDCs. And based on the personal choice of a country, they adopt an architecture to benefit the economy in the particular nation. So one of them is a direct CBDC. What happens here is that, the CBDC is a direct claim on the central bank, and the central bank might employ an intermediary or might not, and they do all the processes that commercial banks normally do. For example, onboarding people, KYC, for example, and they are doing retail payments. So this is the database of the central bank. You see, they are saving all the data of the transaction in their own database. Now, when we go to another architecture, the two-tier retail CBDC, there are two possibilities. One is that of a hybrid CBDC and the other of an intermediated CBDC. Now, what happens with the hybrid model is that, there are payment service providers in between that are, let's say, managing the function as is being managed nowadays with by commercial banks. So they are doing the onboarding, KYC, they might be providing the investment advice to the consumers at the other end. And in this scenario, the central bank is again, recording all the retail balances. So let's say A sent 200, B sent 100, and C sent 300. So all this is in the database of the central bank. Now, as you can see from this configuration, what happens is that there's an additional burden on the central bank. So the primary duty of the central bank was to, maintain the stability of the economy, be concerned about the issuance of currency. But right now, it has to maintain this database. It has to protect it, to prevent it from hackers getting access to this data. And all this data is there. So this also brings about a single point of failure. It's very easy for hackers to gain access to this point, for example, and then they would have all the data associated with all the users in that particular country, for example. Now, when we look at an intermediated CBDC approach, what we see is that we have the payment providers and the service providers in the middle. They are still handling the functions of, onboarding, KYC. So the central bank is not dealing with it. But now what happens in the database is that the central bank is recording the wholesale balances. So like, for example, A had done 200, B had done 100. But what the central bank records is the sum, that is, the sum of the transactions at, let's say, the payment service provider X. And so what happens in this scenario is that, of course, there is less data available for this single point of failure that exists. But at the same time, let's assume that you have payment service provider X, the data is lost. How would, in that scenario, the central bank fulfill all the commitments with respect to the users, since it does not have any idea of the retail balances? Now, there's an alternative design whereby it's an indirect architecture where people go back to, let's say, a blockchain or DLTs, and they are using stable coins. So in this scenario, also, we have a financial institution in the middle who's doing and recording the retail balances. And all this is fully backed by, let's say, stable coins. So if you notice that apart from the direct CBDC architecture, all the other architectures follow the methodology or the mechanism that is followed currently by central banks. And so when you implement these architectures, the shift in terms of stability would not be so huge as compared to, bringing you coming forward with a direct architecture where you directly interact with the end user clients. What happens in that scenario is that, there's a lot of burden on the central bank because it has to offer investment advice. It has to offer services, for example, that the intermediaries or the commercial banks are provided right now to clients. And consider a huge economy, a very big country. If you go with the end users directly interacting with the central bank, for example, all the investment advice, all the support that they get from the commercial banks would go missing. And in a large geographic region, the commercial banks adopt themselves to the particular region they are focusing on, and which will add on to the central bank in that scenario. So what countries should come forward with is a kind of an approach which enhances the existing way it is functioning. And at the same time, it banks upon the advantages of CBDCs. Now, I'll just talk a little about stable coins. So basically, stable coin is a cryptocurrency that serves as a bridge between the stable fiat currency and the volatile nature of cryptocurrency. What is happening is, since the time blockchain came into inception, everybody has started treating cryptocurrency as an investment asset. But at the same time, because of the fluctuations in price, they want stability. And then stable coins were born. They are backed by, let's say, a fiat currency. They might be backed by a precious metal. They might be backed by another cryptocurrency, or they might be backed by algorithms to bring about the stability. And the last architecture that we saw previously, it dealt with the use of stable coins. Now, use cases, I'll quickly skip this because Dr. Ziad has already shed light on this very well. And I come to my main topic, which is basically financial inclusion. So before talking about financial inclusion, I'd just like to share a quote from Muhammad Yunus. And he said that if you go out into the real world, you cannot miss seeing that the poor are poor not because they are illiterate or untrained, but because they cannot retain the returns of their labor. For example, a poor person has no mechanism whereby he can save the money and then, think how I can use this money for my further growth, or for example, and they have no control over capital. So let's say we have someone, there's an SME, and they do not have access to financial services as such. Their trade is also limited. So what they can do in terms of business transactions is just with people in the physical vicinity. Whereas if they have some kind of mechanism where they are giving access to accounts, they can enter into trade and commerce with people living in other parts of the world, perhaps not close to them physically. And it is the ability to control capital that gives people the power to rise out of poverty. So it is very essential that we give this power to people who do not have it, the financially excluded, if we really want people to come out of poverty, if we really want people to progress and make use of their full potential. So what are the barriers to financial inclusion? As of now, there are 1.7 billion people who are financially excluded. First is financial literacy, so they might be lacking knowledge of this. There is limited competition in the financial sector. And what this brings about is, of course, expensive prices and a very poor service model, I would say, because there is lack of competition. Now, the people might have a preference for cash. They do not want to trust banks and, go into using transactions that are provided by banks. And maybe they have personal reasons for not using bank accounts, religious reasons. They might be in a country where, let's say, if I'm a Muslim, Sharia compliance is not supported. I might not go for accessing financial services in that scenario. Then they might belong to the vulnerable population side, senior citizens or disabled people or young children. They might not know how to really, use the services provided by commercial banks. Now, when we talk about a digital initiative, there can be a poor access point coverage. So you have people living in remote regions of the world, and they might want to enter into using financial services, but the proper services are not available in their place. Now, there can be infrastructure issues. So, for example, if you want to allow someone to use the financial services, they should be supported by a government-issued ID, which not all countries have accorded to all the citizens in the country. Now, how will CBDCs help in this scenario? So what happens here is that, there's a strong public sector commitment, because CBDCs are a direct liability on the central bank. So instead of a commercial interest of using people for commercial advantages, we think that because the country thinks for public interest, the design used would be such that it would benefit people more. Now, there would be greater safety to end users. So CBDCs are considered to be a replacement for cash. So what will you see is that, there is no credit risk associated with it. It can be made available to more licensed payment service providers. So the barriers to entry are reduced. Now, it can be this can be an incentive for new people, new players to enter into the market. And you can also bring about an offline capability to reduce the dependence on, using internet. So for people who might have electricity issues, who might not have access to the internet at all times, they can still do transactions by using CBDCs. Now, with the new players, what you will see is lots and lots of innovation. This would result in cost reduction, making it readily available to a larger section of people. And when you are using CBDCs, what you can use is, you can bring forward new mechanisms of payments, like, between IoT devices, for example. And you can also build into the design of the CBDC such that the users have more control on their data. So the data that they are generating, they can, use that data, let's say, for example, to get a loan, by showing that they have been doing these transactions and they have been honoring their commitments, for example. Now, before I leave you, I'd just like you to see this video. This will bring about some of the challenges that a cashless society would pose to people. This is something which cannot be done away with. All of us are moving towards a cashless society. Credit card payments have increased a lot. So if you compare it with, let's say, 5 years back or 10 years back, and this is consistently going to increase. But what are the challenges, that will come forward before we are completely cashless, or when we are cashless? So we have to take into consideration lots and lots of finer points with respect to the population segments that cannot access these services.
Somewhere in the near future, physical money will become like these, relics of a different age, and will only be found in places like this. In other words, hard cash will disappear. It will become electronic, transferred by things like these. So what's the rush to get rid of cash? And what's the cost? Let's face it, money is cumbersome for consumers and banks.
You need to mint the cash, you need to print the bills, you need to transport them in armored trucks, store it in secure vaults, and you need to sort it at the till as well.
Operating in cash costs countries about 0.5% of their GDP every year. But cost isn't the only incentive to move towards a cashless future.
Demand is rising, primarily demand from young generations who are looking for fast, easy-to-use means of payments.
Digital payments aren't just easy, they're neat.
It becomes easier for governments to monitor tax evasion and fraud, so we will have less of that going on, probably.
Having every single payment automatically recorded is efficient, but there's a downside.
Let's assume, for example, that a country that used to be democratic, where people were not paying too much attention about safeguarding their privacy, becomes undemocratic and someone wants to control citizens more closely. They will try to infer from what you buy your political leanings, potentially. And generally speaking, just monitor what you're doing in ways that they shouldn't be doing.
The ballot boxes are kept locked and sealed.
Living in a democratic country doesn't mean you shouldn't be concerned.
They're also worried that private companies perhaps might use this data in ways that are not safe or that you might not like. And for a number of sectors, knowing what you do with your money is very important.
Electronic money trails can allow governments and private companies to access and harvest personal data. But there's another threat that's worrying banks: cyber attacks.
It was a high-tech bank robbery. Capital One suffering a massive hack attack involving
100 million Capital One customers' accounts.
Their personal information stolen.
In March 2019, Capital One Bank was hacked.
A sole hacker managed to steal away 106 million people's personal details in a matter of days. And that attack was noticed just a few months after. You can see that a lot of companies are not very well protected yet against such threats. Pretty much every day we hear of data breaches, cyber attacks that are successful. It's much harder to prevent an attack than to be on the hacker side, because you only need to succeed once as a hacker. Once upon a time, you would have two guys coming in. They would tell everyone to be on the floor. They would put the money in a bag and then run away with the money. And you would get insurance against that. You knew what the risk was. Nowadays, with cyber attacks, they can happen anytime. They can take any form. So it's very hard to insure against.
Still, many countries are fast moving towards a cashless society. In Sweden, the number of retail cash transactions per person has fallen by 80% in the past 10 years. The trend is even evident in far more cash-loyal societies. China's digital payments rose from 4% of all payments in 2012 to 34% in 2017. The trend is inevitable, but a gradual transition is key.
It's important that we have a sort of control as to how fast this happens, because if that's not the case, some people might be left behind.
Some people may find it harder to grasp how much money they have without the physical representation of it. Not everyone knows how to use internet banking technology. And people living in remote areas where internet cover is patchy may find they have to drive for miles for their basic needs. And there's another sector of society that relies heavily on cash.
People living in the street don't carry card terminals with them. So it would be very hard for them, well, first of all, to collect money and to pay for things. They will be among the people who suffer the most from it.
Going cashless is just the latest evolution of money in the modern economy. But it raises a fundamental question. What is the value of money if it doesn't physically exist?
Central banks enact monetary.
So basically, you see that there will be so many segments of our population that will suffer when we are completely cashless. And what we need to ensure is that we have our cash system working together with the CBDCs, for example, or the digital currencies that are being used to ensure that technological developments can catch pace. Years back, perhaps we could not think of people having mobile phones. And you see, majority of the population now in many countries have access to mobile phones. It's considered to be a necessity of life. So this transition period, we have to ensure that there's no radical change. The way central banks are operating, they adopt a design that is, let's say, feasible to the stability of the economy. And it takes into consideration the financially excluded people in that particular economy. And you also have to take into consideration whenever you are designing and implementing a CBDC is that there's a huge gap, I would say, between economists and the technology professionals. You have to take this gap into consideration. Anything that imposes a major technological burden on the central banks should be minimized to ensure that they continue with the supervisory role that they are playing as of now in the economy to ensure stability, rather than, maintaining a database where they have to provide protection to the records and everything. This might happen, let's say, decades from now. But as of now, they have to go forward with a strategy that is minimally disruptive and at the same time provides the advantages that perhaps digital currencies are used for. So with this, I would like to end. Thanks a lot for your time.
Thanks so much, 𝗓𝗏𝗧, Dr. Nida, for that well and beautiful presentation about CBDC and fintech in particular, and how the technology space really looks like. I will not be talking much really, because you've covered a lot of grounds. I would love if Professor Ziyad can come on screen as well, because we're going to a segment where we'll be asking question and answers, and there are a couple of questions that have been sent. The way this is going to work is I will throw the questions. Some were asked during Professor Ziyad's presentation. However, if Dr. Nida has any other perspective to it from tech perspective, please don't let us lose that knowledge. The first question, somebody is asking that, is this from Brother Mustafa Abu Bakr? Is asking, is CBDC a response to cryptocurrency surge to neutralize it? You muted, Professor?
Thank you for giving me permission to unmute. Bismillah ar-Rahman ar-Rahim. Prof. Mustafa, thank you very much for the question. Is CBDC a response to crypto? The argument is yes. One of the key reasons why CBDC was considered was to move the decentralization back to centralization. In the central banks that we've worked with, their concerns have always been that since crypto is gaining ground in their countries, how are they going to offer a legitimate solution to avoid this, causing some instability in the market? So yeah, the effect of neutralizing, unfortunately, as Prof. Yates has mentioned, it may not be a valid argument in that crypto is not used for what fiat is used for. So by introducing CBDC, you're still continuing for what fiat is used for and not necessarily what crypto is used for. So as Dr. Nida mentioned, the primary usage for crypto at the moment is for holding a financial asset or a security, defined differently by different jurisdictions. And that continues. And the trading and the transactions outside the crypto space or outside the 3D internet space or outside the gaming space is quite limited. So the answer is to your question, my view is yes, but it hasn't really been that effective in that.
Great. Thank you so much for that answer. I'm thinking Dr. Nida would want to say something from tech perspective here. Even if CBDC, so to say, is implemented, let's say in a particular part of the world, for example, technology-wise, is that going to bring about reduction in the acceptance of cryptocurrency in that part of the world?
I think if the design of the CBDC is such that it is made attractive to people whom the cryptocurrency is being targeted at, the vulnerable population, the unbanked population, the underbanked population. So when people market cryptocurrency, they talk about the fact that this is the segment of population that is being targeted by the use of cryptocurrency. It's very easy to access. You don't have to do the preliminary requirements that are needed, let's say, by commercial banks. So they really reduce the barriers to entry. Now, if the CBDC is designed such that it mimics the same, then for sure people have more trust in the government. So they would more readily adopt a CBDC as compared to a cryptocurrency, because they would also be guaranteed for protection by the mechanisms that are in place to prevent cyber attacks. And at the same time, they would also be sure that, in case something happens to the reserve that they have or the capital that they have, they will be compensated for. Normally, if there's a theft associated with a blockchain-based platform from the wallets of people, there is hardly any insurance for them, to get the money back. And this is something that the governments can provide.
Beautiful. Thank you so much. Yeah, I think Professor Zed wants to say something. Yeah, please go on. Why is this unmuting you?
Yes, no, sorry, you have to give me permission every time to unmute. That's
no problem.
Thank you very much. Yeah, I mean, Dr. Nida has provided an interesting perspective. In my experience dealing with crypto investors, I tell you that their objectives are not necessarily safety of funds or protection via reserves. Their objective is really driven by primarily, fear and greed. And fear and greed, unfortunately, at the greed level, they want to make a lot of money as quickly as possible. They've seen others do it. So they treat the crypto space, unfortunately, a large portion of them, not all, but a large portion of them treat it as an online casino. And because of that, the introduction of a CBDC really doesn't appeal to that market, the large group that actually is investing to ride the waves and make, overnight millions. So the CBDCs are coming in from two perspectives. One, the stability and centralization, but the customer wants decentralization. So there's the mismatch there. Second, there's the greed element. And as I say, not all, but a large portion of investors are focused on making quick bucks. So therefore, again, the CBDC doesn't resolve that. But the CBDC will be able to neutralize at the lower level where those that were not aware that would want to get into crypto because they see this happening, they may then opt for CBDC as opposed to crypto and then achieve a better level of stability in the market.
Yeah, thanks for that input. I think one thing mentioned by Dr. Nida as well is the way this is structured and the way the government wants to actually build this, if it attracts people. And this is where Sharia lens is going to come in. We can structure something to attract people and it is not Sharia compliant. Whereas we could mimic something else and actually not giving the economic value. I think it's a broad discussion. I don't want to turn it into debate, actually, but there are more questions from the floor. And that question is saying that why does the central bank need to deal directly with household through CBDC without intermediation of banks? I think this is one thing Professor Ziad mentioned during his course of talk here. No way.
Okay, all right. So yeah, there are two things here. One, the central bank does not have to deal directly with the households. As Dr. Nida explained as well, there are different models in which this can be done. So one model is creating a direct CBDC where they are the issuer and they're dealing with anyone that wants to hold it directly, and that's the households and the firms. But if you look at the example of Nigeria, the e-Naira, the CBDCs were issued with the understanding that they would, these e-wallets will continue to be held at commercial banks, and CBDCs would be issued through the central bank. Now, again, this is work in progress, but the objective of the central bank is not necessarily across all jurisdictions to be able to interact directly with the household. It is varied. Some want that access, others are willing to continue through commercial banks, others are still trying to identify what is the right model, what is the right relationship. A good paper to read is a recent paper published by the Australian Central Bank on Australian CBDCs. And this is the lessons learned. It's called Australian CBDC Pilot for Digital Finance Innovation. Australian CBDC Pilot for Digital Finance Innovation. And in that paper, they highlight which models they've tried and what works, and the issue of intermediation. This intermediation is also covered briefly in that paper.
Thank you so much for that insight. I think I have another question. This is directed to Dr. Nida, I guess. Saying, could you discuss the potential risks associated with CBDCs and data privacy breaches and how they might be mitigated?
So I think all the risks that come forward with CBDCs depend upon the design that has been adopted by a particular country to come forward with implementing CBDCs. So there will be a variation in the risks that are in place based on the design that has been adopted. So as with directly with households that Dr. Ziad was answering previously, it imposes a lot of burden on the central banks to provide services that is normally being provided by commercial banks as of now. Now, when we go to a hybrid approach, this somehow reduces the burden on the central bank, but at the same time, the central bank has to, ramp up on the technological side, recruit more professionals, perhaps at the decision-making level from the technology side. And this will take time. There's going to be a divide in the understanding in the way things are perceived, professionals from completely different disciplines. And all these can bring forward a kind of instability in the economy, which should not exist, which is different from the way things are going as of now. But we are eventually going to see this because we need to have a mechanism for digital payments that works in line with the technological developments. And with respect to the data privacy breaches, as I mentioned, depending upon the design mechanism, if the central bank is recording all the retail balances, then it brings forward a single point of failure for people to get access to and manipulate the data that is there, and perhaps I would say force people to take decisions in elections or manipulate them to do things against ethically what they would do. So again, the central bank from a technological side has to hire security professionals who are very smart, who have thought about all the possible cyber attacks. Hackers always gain an upper hand. So even if they think we are going to see such things, but at the same time, they have to do their best. When you go forward with the initiative where you are recording the wholesale balances, what can happen is when there's a privacy breach on the data is that they will not get access to the data of the individual users, but they can know which payment service provider is doing what and dealing with what amount. In terms of medication, so we have to think about education. People have to be made aware how to go about protecting the login credentials, dealing with the devices. Now, when you look at the vulnerable population and you think about cash, there are so many people in the elderly community, so many people, I would say young kids who might have access to cash, but they give it to someone else to buy something for them. And this is something you can't do with a digital currency, because if you hand over your credentials, it's going to give access to your entire, I would say, wallet. And so these are things which we have to think about what to do, possibly, mitigate with a one-time password for each transaction, double authentication, have a kind of mechanism where each transaction is validated by a one-time password, as well as an iris scan of the individual who holds the wallet. And again, this is going to require a lot of advancement from the technological perspective, which as of now, it would take considerable time to implement.
Thank you. First, Ziad, there is this key question around this risk and the major risks from Sharia perspective to all this fiscal or monetary implementation of CBDC. What are the key points to be noted from Sharia perspective to this that are risky?
Well, of course, from the data risk perspective, we want to protect the user. And it comes back to the maqasid. I know, that the maqasid looks at protections, but now we look at metrics. And from the data privacy perspective, these are very clear metrics, clear targets of ensuring that anyone that's making use of these instruments are well protected, they don't lose their funds. So anything that you're looking at from the conventional ethical side, you're naturally going to look at from the Sharia side as well. There aren't, much differences between the protection from the data perspective. One additional element that one may consider is that issues around surveillance in Muslim majority countries tend to be a serious issue, simply because of the political, tendencies within a lot of the OIC countries. So if you look at the number of democracies, in OIC countries versus non-OIC countries, then you have to consider whether CBDCs will actually be putting users at risk in governments that are not democratically elected or not, or don't have a very good human rights record.
Yeah, thank you very much. There's a question from 𝗓𝗓𝗁𝗓𝗔. Permits me if I pronounce the name wrongly. I think this to Dr. Nida probably. One question says, are there alternatives to DLT to EU CBDC? I will understand DLT to be distributed ledger technology, if I'm right.
Yes. So basically, as of now, the way people are considering to issue CBDCs is without using blockchain. As Dr. Ziad also pointed out, when you use something like a DLT, specifically blockchain, what happens is that there is a massive reduction in scalability, which you can gain by using a centralized database. So DLT, I would say, is not the optimum choice as of now, which countries are considering. to issue CBDCs on. And when you think about alternatives, so you have centralized databases, whether you are using a graph database, whether you are using SQL, for example, or you are using some other database to record your data. So that is being done to issue CBDCs as of now, and they are not going forward with using blockchain. Studies that have been done have not pointed in favor of using blockchain, because when you bring about decentralization into this aspect, you need to have a reconciliation of data or uniformity of data across multiple stakeholders, which would have access to this data. And this can violate the privacy laws that are prevalent in an economy. For example, when we think from the context of Europe, we have GDPR. So if you're using something like a blockchain to issue a CBDC, what will happen is that there is a right to be forgotten as a part of GDPR, and you will not be able to implement that. So you have the data on a permanent database if you're using permission blockchain as well. So you would have to really do away with the permanency of blockchain to come forward with a resolution in a permission blockchain, whereby it allows for the erasing or deletion of data. And this goes against the spirit of decentralization and blockchain. So there is really, I would say, no good proposition to go forward with a DLT in issuing a CBDC, unless there are some specific design requirements based on the country that is backing it.
Yeah. Another question around DLT is, can the offline functionality work with DLT or account-based CBDC?
No, I don't think so. Why? Because when you are dealing with the DLT, you have different people, possibly in different geographical regions, who need to approve a transaction to be valid. In case of a centralized issuance of CBDC, you can have a hardware device. They do the transaction, the transaction is recorded in the device, and whenever the person has access to the internet, that transaction is settled. But when you are using a DLT, it needs to be updated in real time for all the transactions that are taking place. It needs to approve the transactions. So really, you should have an access to internet connectivity to bring about the realization and the uniformity of all the stakeholders, let's say, who are approving and validating the transactions, which would be very, very difficult to achieve in case of a DLT or account-based CBDC, when you think specifically in terms of the usage of blockchain.
Okay, thank you. I have another question. I think this from 𝗓𝗵𝗵𝗃𝗃. This should go to Dr. Ziad. Said I had CBDCs gold or silver backed. What are they being planned?
Prof. Mustafa, no, they're not.
Yeah, as simple as that. Okay.
Nothing more to say. Yeah, they're not. They're not backed by gold and silver.
Yeah. Okay, Dr. Onida, there is one question around. Are there data from countries, and Professor also mentioned talk around data, you also talk around data. Are there data from countries that have launched their CBDCs that show the impact on financial inclusion for such countries and jurisdictions?
I would say there's a recent paper by Bank for International Settlements, which specifically deals with financial inclusion and CBDCs. And you should try to search for it and read it. I think it was dated as March 2023. So I would recommend having a read into that. And I'm sure they are delving into the data aspect as well by providing validation wherever they have access to the data.
Yeah, great, beautiful. One other question, last one from me, because you talked around financial inclusion a lot. And there is this question currently, people are asking, is it actually financial inclusion or financial exclusion actually? Countries all over the world now, when we say we want to introduce something, let me create a use case. When we have SEPA, we have ACH and all of these SWIFT messages around the globe. And there's going to be transfer using the CBDCs. There's going to be a kind of charges that is going to be included. And this is actually from third parties and intermediaries between them. All these charges is falling back on people we want to actually include in the, and Professor can talk about this from Maqasid of Sharia as well. That is in the downline is going to increase what whatever amounts they're going to be paying. Either they're using shared or beneficiaries, or they're using whatever, share hour, or are we actually doing financial inclusion by introducing all these things? Or are we other way around exploiting people and saying it is financial inclusion? Are we excluding them actually or including them? I would like perspective from both Prof and Dr. Nida.
Please go ahead, Dr. Nida.
Okay, so I would say the spirit is to financially include, but perhaps in the beginning, what you will see because of the recent developments, lots of capital requirements to bring about the implementation, there would be a phase where people would shy away from, I would say, the cost that is involved. But as with all technological initiatives, the prices always go down, whether it's a smartphone, you have alternatives coming up. And when there is going to be lots of competition in the market, you can be assured that they are going to be service providers that are growing to, going to bring down the costs a lot. So even now, when you look at different service providers, you have PayPal, for example, and then you have Wise. So there's a massive reduction in the transaction cost that is there. So similarly, when you come forward with this initiative, they are going to be players who are going to bank upon the fact that they are providing nearly free payment transactions, which the people can gain access to and use. And that is one of the things that people fear also, because the technology giants, they are so well accustomed to developing these initiatives that they can really take away a large market share from, I would say, the people who have been dominating the market as of now. So definitely in the long run, financial inclusion. And because this is all digital, the stakeholders, the government bodies would be more answerable to what they are doing, because there's more transparency as per se, based on what you can go back to the government, the body that you have elected, that this is what you promised and this is what we are getting, kind of a thing.
Thank you so much, Dr. Nida, for that. Prof, inclusion or exclusion?
Yeah, I mean, I agree with Dr. Nida. I think initially it's going to be that everyone wants to get into the space, but as competition will thin the herd, I think what will probably happen is financial inclusion going forward. But something that I have been suggesting over the last 2 years is what we have done for financial intermediation in Malaysia, where we've implemented VBI, or value-based intermediation. And then we've done it for 𝗕𝗵𝗆, value-based intermediation for 𝗕𝗵𝗆. I think that it is time to look at a framework of value-based digital finance or value-based digital intermediation. And I think this needs to be done very quickly, simply because more from the fintech side, we're seeing more and more P2Ps and approaches to lending or providing of easy access to finance. And a lot of these people who have not had access to finance before now just need to tap their phones and they can quickly get $1,000. So this creates, an indebted society. This does not necessarily promote a productive, consumption, or rather a productive expenditure, but it's consumption expenditure, and just creates more debt traps. So value-based digital finance really needs to be structured and really knocked out in terms of a framework to guide any fintech coming into it. At least from the Sharia space, it's a serious issue.
Wonderful. Thanks from the family of Islamic Finance Connect to both Dr. Nida and Professor Ziad. Before I come to our presentation to both of you, we'd like to mention that Islamic Finance Connect is welcome and welcoming everybody to visit their website. There are a couple of stuffs going on there. We have vlogs that go, please visit. Also, we hold sessions like this all the time. Please, if there's any topic you would love us to bring on board again, this to the audience, please feel free to message us and we're going to kickstart something on that. Also, Islamic Finance Connect, we do a kind of mentorship for students in Islamic finance space, or if almost everybody in the Islamic finance team are graduates of Islamic Sharia, Islamic finance, and a couple of guys there, they also are certified with IOFI certification, CSAA, and many other certifications. I'm part of the family, of course. Also, we develop businesses from Sharia perspective for people looking to research, and many other things we do. Education is ongoing. There are other programs we want to roll out soon, and we'll be sharing it with the public space. Because we have spent more than 4 minutes from the time we actually agree for this, I would like to present award from Islamic Finance Connect to our speakers. Firstly, this is the sunnah. When you go to Eid, you go through one place and come back through the other. So I started with Dr. Ziad. So let me start presenting from Dr. Nida. Thank you very much for answering our call. And we hope we're going to call you again soon. And we believe you're going to answer our calls again. Thank you so much. 𝗓𝗏𝗧𝗏. This is just a token from us.
Thank you so much, Brother Ibrahim, and thank you so much, Islamic Finance Connect as well.
Thank you so much. Also, Dr. Ziad, thank you so much for this. This is just a token from Islamic Finance Connect presented to you. We really appreciate your mentorship and support all the time. 𝗓𝗏𝗧𝗏.
Ameen. 𝗲𝗂𝗵 𝗏𝗏𝗍𝗂. Thank you very much for the opportunity to share some of our thoughts. Barakallah.
And thanks to the audience as well. We really appreciate everyone on board, and we'll be getting in touch with you very soon as well. If there is no other question, comment, thank you everyone. Assalamu alaikum wa rahmatullahi wa barakatuh.
Wa alaikum assalam.
Alaikum assalam wa rahmatullahi wa barakatuh.